Welcome to the deep dive.
Great to be here.
Today, we're plunging into a corner of the crypto world that's genuinely turning heads. It's a project called Ethena. And it's not just another digital asset, you know?
Right. It's trying to do something pretty different.
Exactly. Ethena promises a truly new kind of digital dollar, and even something they call an internet bond.
Yeah, that internet bond concept is key.
It really could fundamentally shift how we think about stable money online.
It definitely has that potential.
Now, when you hear digital dollar, you might think of, well, the stable coins we already have. But Ethena aims to be different.
Very different in its mechanics.
An internet bond that earns you money without relying on a traditional bank. That definitely piques my curiosity.
It absolutely should. We're going to peel back the layers of Ethena today. It's what's called a synthetic dollar protocol built on Ethereum.
Synthetic dollar.
Yeah.
Okay. So not directly backed by cash.
Exactly.
Think of it as something that mirrors the value of a traditional dollar, but yeah, isn't directly backed by a pile of cash sitting in a bank account.
Gotcha.
Our mission today is to really understand how this, well, ambitious project works, what significant problems it aims to solve.
Right.
And why it's managed to attract such incredible attention and capital. I mean, it's already soared past $12 billion in value by, what, September 2025?
Wow, but $12 billion.
Yeah, positioning itself as the third largest stablecoin. It's a really bold vision, and there's definitely a lot to unpack.
Okay, so let's start right at the beginning. You mentioned it's solving significant problems. But I thought we already had stable coins like USDC and USDT, you know, the ones supposedly tied to the dollar.
We do.
So what big issues are those missing that Ethena is trying to fix?
That's an excellent question, and it really gets right to the heart of Ethena's innovation.
Okay.
The crypto world faces what's often called the stablecoin trilemma.
The trilemma, I've heard that term. Yeah, it's this incredibly tough challenge. How do you create a stablecoin that is all at once decentralized, truly stable in value, and also highly scalable?
Decentralized, stable, scalable. Okay.
Existing stablecoins, well, they often have to compromise on one or maybe even two of those pillars.
Right. So how do the current ones compromise, like USDC and USDT?
Well, let's look at those first. They're centralized stablecoins.
Okay.
They keep their dollar peg by holding, you know, an equivalent amount of fiat currency, actual dollars, in traditional bank accounts.
Right, like reserves.
Exactly.
Yeah.
Now, while they generally offer stability and they are quite scalable, they're inherently not decentralized.
Because they rely on banks and the companies behind them.
Precisely. They're vulnerable to the very same risks as traditional banks. Things like bank failures, regulatory pressure, and even censorship. Assets can be frozen or seized.
Ah, okay.
Yeah.
So if you're looking for truly permissionless internet money, something free from traditional financial controls, these kind of fall short.
They do. That's the trade-off. You get stability and scale, but you lose that decentralization.
Okay, so that's one side. What about the other main type? You mentioned over-collateralized ones, like DAI.
Right. On the other side, you have things like DAI. These aim for decentralization by being backed by other cryptocurrencies.
Okay, so no banks involved.
No banks. But the catch is, you have to lock up more crypto than the value of the stablecoin you receive.
More. How much more?
Well, typically, think like putting down $150 worth of Ethereum to get maybe $100 worth of DAI.
Oh, wow. That's quite a bit extra.
It is. And while this adds a safety buffer, it makes them incredibly capital inefficient.
Yeah, I can see that.
You need a lot of locked up capital just to generate a relatively smaller amount of stablecoin. And that ultimately limits how much they can grow, how much they can scale.
So they hit decentralization and stability maybe, but struggle with that capital efficiency and therefore scalability.
You got it. That's the dilemma.
I see the trilemma much clearer now. Ethena then is essentially trying to hit that sweet spot, creating a digital dollar that's more resilient, efficient, free from those traditional bank ties, and scalable without being so capital inefficient.
Exactly.
Yeah.
Athena's core idea is to create truly crypto-native money in this internet bond.
Right.
Imagine digital cash that's not only globally accessible and resistant to censorship.
Meaning no single entity can just block your transactions or freeze your funds.
Correct.
Yeah.
But also, it needs to be incredibly scalable, making it practical for, you know, widespread use.
Yeah.
And here's the kicker, the really unique part. It can actually earn you a yield, interest, without ever touching the traditional banking system.
Okay, that's the part that sounds almost magical.
It does feel a bit like that at first glance. It's not just about recreating the dollar. It's about building an entirely new financial primitive for the internet age.
An internet bond paying interest, completely outside traditional finance. That definitely sounds appealing, especially, when traditional savings accounts offer next to nothing.
Yeah.
But how does something designed for stability also manage to generate such attractive yields? That still feels like a contradiction to me.
It's a fantastic question, and it really highlights Ethena's, well, ingenious mechanism to help you visualize it. Imagine you have a special piggy bank.
Okay, piggy bank.
For every dollar you put in, you also have a special magic box.
A magic box, right?
This magic box constantly adjusts itself. It promises to either make up for any loss or take away any gain if your dollar's value fluctuates.
So it cancels out the ups and downs.
Pretty much.
Hmm.
The net effect is your total dollar amount always stays stable. That magic box, that's Athena's delta-neutral hedging strategy.
Delta-neutral hedging.
Now, the magic box isn't just about stability. It's also about finding clever ways to generate income from the crypto market itself, not from, traditional lending.
So this magic box, this delta-neutral thing, sounds like the real secret sauce here.
It is.
Okay, let's unpack that mechanism then. How does it actually work to keep the USD stable and generate that yield?
All right, let's dive deep into the delta-neutral hedging. It's all about balancing risks to maintain stability while, at the same time, generating income from crypto market dynamics.
Okay, step by step.
So the first step is a collateral deposit. When you want to create USD, Athena's synthetic dollar, you deposit approved crypto assets. These can be major ones like Ethereum or Bitcoin. But particularly important are liquid staking tokens, or LSTs, like STEF.
And LSTs, like STEF, that's basically a token representing staked Ethereum, right? So it's already earning some yield from staking?
Precisely. That's one source of yield right there. Now, here's where the hedging magic comes in, the hedging trade.
Okay.
As soon as you deposit your collateral, Athena's system instantly opens an equivalent-sized short position on a centralized crypto exchange.
A short position, meaning betting the price will go down.
Exactly. It uses perpetual futures contracts for the same assets you deposited. So if you deposit ETH, it shorts ETH.
Perpetual futures contracts. That sounds complex. What are those, basically? And how do they help hedge?
Yeah, it's a bit of jargon. Think of them as special trading contracts. Like regular futures, they let you bet on the future price of an asset without actually owning it.
Okay.
But here's the crucial difference. They don't have an expiry date. Perpetuals.
Ah, so they can keep the hedge going indefinitely.
Right. Athena can maintain its hedge continuously without having to constantly roll over contracts. So when Athena opens that short position, it's making a bet that the price of, say, Ethereum will go down.
Okay, let's use your analogy again. The house one.
Good idea. Imagine you own a house that's your deposited crypto, like Ethereum.
Right.
To protect yourself from its value going down, you make a side bet, the short position that the house price will drop.
Okay.
If the house price falls, you lose money on the house itself, but you win on your side bet, ideally by the same amount.
Ah, so it balances out.
And if the house price goes up, you gain on the house, but you lose on the bet. Again, it balances. The net effect is that your total wealth, the value of your house plus your side bet, remains largely stable.
Delta neutral. The value stays neutral to price changes. Got it.
Exactly.
Okay, I get the stability part now. That makes sense. But where does the yield come from if it's all about balancing gains and losses? That still feels like the magic trick.
Right. That's the clever bit. The yield generation. It's powered by two main sources.
Okay, source one.
First, as we touched on, the staking rewards from the liquid staking tokens themselves.
Like the STETH.
Yep. STETH often yields around, say, 3–4% annually just from the underlying Ethereum staking. That's baked in.
Okay, that's straightforward enough. What source two?
The second, and often more significant source, comes from something called funding rates on those short perpetual futures positions.
Funding rates. Okay, you mentioned that. It sounded like a fee. How does that generate yield for Ethena?
It is a periodic payment, yeah. Typically exchanged every 8 hours or so between traders.
Between the longs and the shorts.
Exactly. Between those holding long positions, betting the price goes up, and those holding short positions, like Ethena, betting the price goes down. It's basically a mechanism to keep the futures contract price tethered closely to the current spot price of the asset, like keeping the tail wagging with the dog.
Right.
Now, what's crucial here is that historically in crypto markets, there's often more demand to go long. More people betting on prices rising.
That makes sense. Generally optimistic market.
Right. So when demand for long positions is high, the longs actually have to pay the shorts a funding rate to maintain their positions.
Ah, so Athena, by always holding these short positions,
Mm.
it often ends up receiving these payments from the traders who are betting the other way.
Exactly. That's quite clever, isn't it?
Yeah, it really is.
And these funding rates, they can be substantial. Historically, they've generated anywhere from, say, 7% to 20% annually. Sometimes, in really volatile times, they've even soared over 50% for those holding the short side.
Wow. Okay.
And this income, importantly, is generated directly from crypto market dynamics, not from traditional banks or lending activity.
Got it. Market mechanics generating yield?
Precisely. Now, there's one more crucial piece here, a safeguard.
Okay.
It's called off-exchange settlement, or OES.
Off-exchange settlement.
What's really interesting here is that Ethena doesn't actually send your deposited crypto directly to the exchanges where it runs its hedges.
Oh. Where does it go then?
It uses institutional custodians. Think like Copper or Fireblocks. These are third parties.
Okay.
This means your actual collateral, your ETH or STETH, stays with an independent trusted custodian. It's not sitting on Binance or Bybit or wherever the hedge is.
Ah, so that reduces the risk if an exchange gets hacked or goes bankrupt. Like what happened with FTX?
Exactly. We all saw the dangers of leaving assets directly on exchanges during the FTX collapse. OES is a major risk mitigation strategy here. It separates the collateral location from the hedging venue.
Okay, that makes a lot of sense. So Athena's found a way to create a stable asset, generate potentially significant yield through staking and these funding rates,
Right.
all while keeping the collateral safer with independent custodians using OES. That really is a sophisticated dance.
It is quite complex under the hood, yeah.
So, given all this, what are the practical everyday benefits for someone like me? Why should I really care about this USDD and SUSD?
Right. Let's bring it back to the user. This is where it gets really interesting for you and why that internet bond idea is so compelling.
Okay, lay it on me.
First, you get potentially high crypto native yield.
The yield, yeah.
Unlike traditional stablecoins that often offer, well, basically nothing.
True.
SUSD, that's the staked version of USD, the internet bond part, has consistently offered pretty attractive returns.
How attractive are we talking?
Well, it averaged around 19% in 2024,
Whoops.
and at times it even peaked over 50%.
19% average. Wow, that's huge compared to a bank.
It is, and remember, this isn't bank interest.
Yeah.
This income is generated directly from those crypto market mechanics we just discussed. For someone looking for a better return on their digital cash, well, this is potentially a game changer.
Yeah, those are truly eye-popping numbers, but
Yeah.
is that level of yield sustainable? It almost sounds, too good to be true sometimes.
That's a really valid and important question. We'll definitely circle back to that when we talk about the risks involved.
Okay.
But fundamentally, the source of the yield is just different. Second benefit, censorship, resistance, and independence.
Right, the internet money aspect.
Exactly. It's independent from the traditional banking system. What that means practically is your funds are less susceptible to being frozen or subject to government intervention compared to fiat-backed stablecoins, which rely on those bank accounts.
So sort of like my money is my money, less controllable by intermediaries.
That's the core idea, yeah. Imagine a world where your savings can't just be arbitrarily blocked. That's part of the promise here.
Okay, what else?
Third, Ethena offers incredible scalability
How so?
because its collateral model is essentially $1 of collateral for $1 of USDAI. It can scale much faster and much larger than those over-collateralized models we talked about earlier, like DAI.
Right, less capital needed to mint each stablecoin.
Exactly. And the proof is kind of in the pudding here. By September 2025, USD's market cap had already shot past $12.4 billion.
Making it the third largest stablecoin already.
Yep. That rapid adoption really demonstrates its potential to become a truly global digital dollar.
It's moving incredibly fast then. What kind of traction has it seen in the wider crypto world? Is it being used?
Yeah, definitely. That brings us to the final point. Wide adoption.
Okay.
Ethena has seen explosive growth. We mentioned the market cap, but its total value locked, or TVL, the amount deposited into the protocol, is nearly $12.9 billion by September 2025.
Almost $13 billion locked up.
Right. And it's integrated across, I think, over 24 different blockchain networks now. Plus, it's partnered with major DeFi protocols, think MakerDAO, AIF.
So it's not just an isolated project, it's plugging into the existing ecosystem.
Very much so. It's actively being used and integrated across the digital finance landscape.
Those benefits certainly paint an incredibly optimistic picture. A stable, high-yield digital dollar outside traditional banking. It really sounds like a fantastic leap forward.
Mm-hmm.
However, you mentioned earlier that Ethena's model is innovative, and, well, innovation often comes with unique challenges, right?
Absolutely.
So before I get too carried away, what are the potential downsides? What's the tightrope Ethena has to walk here? Because nothing in finance is ever entirely without risk.
You're absolutely right to ask, and it's crucial to understand these. With great innovation often comes unique and sometimes complex risks. Athena's model, while brilliant in many ways, definitely walks a tightrope.
Okay, what's the biggest worry?
One significant risk is negative funding rates.
Ah, the flip side of that yield source.
Exactly. The attractive yield of USD heavily depends on those funding rates from the short positions remaining positive.
Which they usually are, but not always.
Right. What happens in a prolonged bear market? Or even just during periods of extreme market fear or panic?
People might rush to short, driving rates down.
Precisely. Funding rates can turn negative. And if they do, it means Athena would actually have to pay to maintain its hedges.
So instead of earning income, it's costing them money.
Correct. And that could potentially erode or even negate the yield it offers. It could also put significant pressure on its reserve fund.
They have a reserve fund for this.
They do. It currently stands at, I think, over $61 million, specifically to absorb periods of negative funding.
Okay, so there's a buffer.
There's a buffer, but a prolonged or severe period of negative rates could certainly test its resilience. And ultimately, that could impact the stability of USD itself if the fund were depleted.
Okay, negative funding. What else?
Another area is counterparty risk,
Even with the off-exchange settlement.
even with OES. While OES significantly mitigates the risk of losing the collateral if an exchange fails,
Right.
Athena still relies on the operational stability and solvency of those centralized exchanges where it executes the hedges.
So if an exchange just suddenly halts trading or has major issues.
Yeah, a sudden failure or even just a major technical issue with the big exchange or even one of the OES providers themselves could still disrupt Athena's hedging operations or the settlement process. It's a reduced risk compared to leaving assets on the exchange for sure, but it's not entirely eliminated.
Okay, operational risk from the partners. Makes sense.
Then there's regulatory uncertainty. This is a big one for pretty much any new financial primitive in crypto.
Yeah, regulators are still figuring this all out.
Exactly. How do you classify synthetic assets like USDD and SUSD? Are they currencies, securities, something else?
Has there been any action already?
Yes, actually. The German financial regulator, BaFin, already took action against an Athena subsidiary operating in Germany.
Oh, really? What did they do?
They classified SUSD, the yield-bearing part, as a potential unregistered security and restricted its operations there.
Wow, okay. That's significant.
It is. It's not just an isolated incident. It sets a potential precedent. It really highlights the ongoing challenge of operating in different jurisdictions as governments grapple with how these new types of digital money fit into existing financial rules.
Yeah, that's a huge hurdle. If one major regulator steps in, others might follow suit, really impacting its global reach.
It's a major overhang, absolutely.
And I remember you mentioned something about the hedging system itself being centralized.
Yes, that leads to the final point we should cover, the centralization of the hedging system.
Okay.
While Athena's smart contracts for, issuing and redeeming USDD are transparent and run on the blockchain,
Right, you can see the code.
the core software that manages all those complex short positions across multiple exchanges, what they call the hedging system, that's an off-chain centralized component run by Ethena Labs.
Off-chain and centralized, so we can't see exactly how it works.
Pretty much. It's internal algorithms, it's risk management parameters, how it decides which exchanges to use. That's not fully transparent or auditable by external parties in the same way a smart contract is.
So there's a kind of black box risk there. We have to trust the Ethena team is managing it correctly and fairly.
Essentially, yes. You're trusting the Ethena Labs team to manage this absolutely critical system flawlessly and without bias.
Okay, that adds another layer of risk to consider.
So yeah, putting it all together, what does this mean? Athena is definitely a groundbreaking project. It has this bold ambition: build a scalable, censorship-resistant, and high-yield digital dollar.
That internet money or internet bond.
Exactly. It achieves this by, cleverly combining crypto assets like staked ETH with this sophisticated delta-neutral hedging strategy on centralized exchanges.
It's a truly bold attempt then, trying to redefine stablecoins. offering those potentially very attractive returns and genuine independence from traditional banks. But, as you've really clearly highlighted, it's also navigating some pretty complex market dynamics, faces significant regulatory hurdles, and has these operational risks inherent in such an innovative and somewhat centralized model.
It's a fascinating tightrope walk, really,
Yeah.
between immense potential on one side and considerable risk on the other.
This is actually a great point to quickly pause and remind our listeners of something.
That's right. If you're enjoying how we break down these complex projects into, well, hopefully simple pieces,
Definitely helpful.
helping you get truly well-informed without the information overload, and you want more deep dives, just like this one, make sure you subscribe to our channel, CryptoBox.
Yeah, we do all the complex research and try to distill the key insights so you don't have to wade through it all yourself.
Exactly.
So as we wrap up this deep dive on Athena, maybe here's something to ponder. If, and it's still an
Big
if Athena successfully navigates these market challenges, the regulatory minefield, and proves its model resilient over time, could its high-yield, decentralized internet bond fundamentally change how everyday people, globally, save and transact money? Could it offer a credible alternative completely outside the traditional banking system?
It's a powerful question. The potential is certainly there.
It's definitely something to think about as this whole digital finance landscape just keeps evolving so rapidly.